I guess I'll call the meeting to order. Do we have a quorum?
Yes, sir.
In attending the meeting, we have Vice Chairman John Smith and regular member Catherine Burton.
Martin.
Okay.
Martin.
Barton. I'll call for the approval of the minutes. Hopefully everyone got a copy of those. Is there a motion to approve the minutes or any additions?
To approve the minutes.
Second.
All in favor?
Aye.
Aye. Did you say aye?
Excuse me.
Yes.
Oh, okay.
Y'all turn on your microphones and pull them a little closer, please.
Okay. How's this? This sound better? Okay, well, we have a fairly lean agenda today, at least of formal topics. At this point, I'll assume the minutes are approved.
Yes, sir.
And we're open to any public comment that, okay, we'll pass through that. Cindy, I'll hand it off to you to deal with the two finance director matters, payoff of the two loans.
So back in April of last year, you, as a Finance Commission, unanimously endorsed the staff's recommendation as to the use of residual proceeds and cash after the sale of the electric utility. And one of these recommendations was to pay off the 2007A marina property loan, and that, as a result of that endorsement, the payoff of this loan was actually budgeted as part of the fiscal year 18-19 approved budget. So we closed the electric utility sale on December 17th, and we have the funds available to do this budgeted debt payoff. But council had asked that we, before we did it, even though it's budgeted, that we review it and bring it back to them for a final approval before we actually transfer the funds to the bank. So one of the things we've talked about in the past, and there has been some confusion about, is that this loan contains, as does the other one we're going to talk about it, a prepayment penalty clause. And that clause makes some adjustments for the taxable loan rate, but it also does take into account the potential earnings by the bank on the early payment and the present value of those earnings at the Treasury rate. And so as a result, you do actually have a savings from the retirement of this debt, a savings both in cash across the life of the loan, as well as a present value savings on the payoff of this debt. And so I kind of outlined some numbers here for us to look at in the middle of this memo, and I'm hoping everyone has a copy of the memo that I'm referencing. So we adopted a budget that said it would take $3,318,000 to pay off that loan with the cash. The actual costs of the payoff, including the principal and interest payment we already made on October the 1st, so that we have apples and apples, as well as the bank's payoff effective today, comes to $3,032,104. And the remaining payments over the life of the loan, if we just went ahead through the rest of the amortization schedule and made those payments from 10/1/18 through the maturity date on 10/1/2027, is $381,039. So you can see already from the budgeted amount to the remaining loan amount, there already was a savings projected, but it wasn't quite as big as the amount that we now know is the true savings based on the bank payoff. I will tell you that when I budgeted for this, I did a fairly extensive analysis of the prepayment penalty clause with the Treasury rate, and one of the factors in this prepayment penalty clause is the maximum corporate tax rate. And for a long, long time, that was 35%, so that's how I ran my analysis. That was lowered to 21% by the Tax Relief Act last year, and when you use that 21% and plug that into my, my spreadsheet analysis, I come up with a number very, very close to the banks, so I feel comfortable. It's in our favor. favor, because it's an adjustment to the taxable rate that makes the new rate lower than it would have been at the 35% maximum corporate tax rate. So I feel comfortable with the bank's numbers, and I feel comfortable with these savings of $350 almost cash over the life of the loan, and even on a present value basis, about $135,000. So we're saving money. But in addition to saving money, we will have the opportunity to free up the money that we need to make investments in capital in the marina. You know, when I wrote this memo, it was before yesterday's council meeting, and so I wrote it from the perspective of no matter what we decide to do with the marina, it makes sense to pay off the loan. If we lease it and we still have the loan, then the lease payments, we'll get them, and then we'll have to take that $340,000, $350,000 a year out of that, and what do we get? And if we keep it and manage it, even through a management firm or ourselves, we have no money to put into this marina. That's the problem that we find ourselves in right now. And one of the things I attached to this particular memo was a little marina cash flow actuals that I prepared for the evaluation committee that reviewed the RFPs we did receive, to kind of put in perspective what's been going on. And you can see from that attachment C that in the last few years, after we take our debt service payments and our transfer to the general fund out of our net cash from marina operations, we have either negative amounts of money left over or like $40,000. We have no money to make those capital improvements. Certainly not sufficient capital improvements to keep pace with depreciation expense and the basically the using up of those assets. And so even if we weren't saving money from paying this loan off early and having the opportunity to retire debt with proceeds from the sale, we made this recommendation to pay this debt off probably at least a couple of years ago as a way to find our way out of the morass the marina is in. If you saw the council meeting last night, council made the decision to keep the marina and to hire a marina manager and to prepare a engineering study or survey, if you will, of the marina condition and the probable costs for the repairs and a priority for those repairs for safety, et cetera. And so this loan payoff gives us the opportunity to then hand that new marina manager some wherewithal to go forth and start making the first set of repairs and improvements, and then move forward into that engineering studies recommendations for long-term capital improvements. So with that, I can answer any questions you might have, but staff is still recommending that the city proceed as we budgeted to pay off this loan at the earliest possible date with city council approval. You'll notice the bank payoff is only good through January the 22nd. I can only get one good for 10 business days. So if I can get a motion and a vote from the Finance Commission to recommend this to council, I'll re-up the bank's quote, and it'll be valid through past the council meeting date so that we can then pay it off. I don't anticipate it's going to change much because I don't believe the Treasury rate has changed dramatically in the last few days. But I will have to redo this, and the savings may be slightly different, better or worse, but I think there will still be savings. So with that, I'm happy to answer any questions that you might have about this, or entertain a motion from you to endorse staff's recommendation to pay off this loan. And also, I don't know if the city manager has anything he wants to add to that.
So, Cindy, the effective rate that you can invest, like the proceeds of the fund, is what, under 2%?
I've been using 1.2%. That's what I used in this analysis of use of the proceeds. That's what I used in this present value analysis. We're restricted by law to bonds and federal instrumentalities and treasury bonds, and we're also restricted to like a 7-year investment horizon. And frankly, we've had years where that was 0.2% and years where it's right now ranging around 2.5%. But at all points in between over the last 5 years, I'm being very conservative with 1.2%. Even if I take my net present value or my present value savings calculation up to the current, like 2.5 for the Treasury rate, there's still a slight present value savings, and the cash over the life of the loan savings remain. So I feel pretty comfortable that no matter how you slice it, we are saving money.
So really two benefits. One, clearly it's a decent financial investment to pay off this loan, given other opportunity costs. And secondly, it allows the marina to operate as an enterprise fund without other adjustments to fund capital.
Exactly, without other well-strapped revenue sources having to also throw in the capital investments to the marina, because the only other reasonable source we have for that is 1 cent sales tax, which is already, we'll talk about that in a minute, already over we don't have enough as it is for stormwater, streets, other aging city facilities. And so I think this makes really good sense, and I think particularly in light of what we decided, or the council decided last night about the marina, the sooner the better, so that we can get on with our budget for the year. The marina's budget for this year actually assumed the payoff of this loan because it was budgeted that way based on the Finance Commission's recommendation. There's a couple of things within the marina's current year budget that it cannot do unless this loan is paid off, including that purchase of the forklift and some of the other capital improvements that were even scheduled to be begun this year. I know Mr. Druitt's here. He made a recommendation that they immediately get $100,000 and start looking at the, I think what he termed the low-hanging fruit or the quick wins. We don't have any funding for that. And also, we would be looking at doing this engineering study to assess the condition of the marina, and there needs to be some funding for that. So paying off this loan sooner rather than later makes the marina's current year budget possible and makes us able to move this forward.
I think it was great that you clarified the present value, or not the present value, but the time value of money credit, that I may not be using the right term, but essentially that the bank puts into the calculation. Because I think in the minutes of one of the discussions of a prior Finance Commission, there was a statement that said, we will have to pay all the interest, and we're not going to have to.
And in the budget workshops, I clarified that we weren't paying all the interest. I was trying to manage everyone's expectations with regard to the paying off this loan early and saving tons and tons of money, because I knew there was a make-whole provision of some kind and hadn't had the opportunity to calculate it to this level of detail. One of the things that I've talked with people about is, why do we have a prepayment penalty? Back at the time these loans were taken out, typically the conversation with your financial advisor is it's a trade-off between a lower interest rate now or a call provision and a slightly higher interest rate. And for whatever reason at the time, they planned to keep these loans in place, and they went with the lower interest rate rather than the call provision without penalty. So that's just where we find ourselves.
And that penalty is about what the call provision would have required at the time.
Kind of,
the same category.
Some of our other loans can be prepaid on or after a certain date that was a certain distance into the life of the loan without penalty, meaning for the outstanding interest plus the outstanding principal plus accrued interest to that date with no calculation for interest lost in future years. And so this is a little harsher than those that we've paid off before with call provisions.
I didn't see the meeting last night, so you've answered most of my questions already. Was there a provision to commit the savings to capital improvement from the paying of the bond, or was that left open last night?
From my impression, they understand that paying off this loan will free up that money. It frees up the money in the marina, so you would have to actually physically transfer the money out of the marina to somewhere else, and I didn't hear anything that indicated they were planning to do that.
Yeah, and they passed the budget.
Yeah, and they passed the budget that includes this as well,
to
free that money up. So no, I think there was a lot of interest, and council are the ones who authorized us to go forth and get one of our coastal engineers to go over there and start figuring out what it's going to take to bring it back up to snuff. So I think...
I reviewed the proposals, and there are plans in there. I assume they've seen those too.
They did. They hired an engineer. Certainly their take on what the priorities for five-year capital were probably more focused on their chance of profit making. We would feel more comfortable if one of our engineers went in there and put safety first, and then, and kind of like restoration of the existing infrastructure as opposed to, new things that may be a little farther down the priority list. And also, our coastal engineers may likely end up being the people who manage the projects as well, and so it would be best to have them in there from the get-go. But yeah, one of the proposers did do that.
Yes.
Yeah. And we have that to draw on,
and
we'll certainly provide that to the engineer that does the work for us, but I think we can make our own assessment. So,
Catherine?
Sounds good.
Sounds like a good idea.
Yeah. Sure. No,
I'm thankful for the clarification on that interest, that there was
Sure, I move we
an
approve.
offset.
Because if you look at the 2019 to 2028, payoff, if I understand this correctly, the interest payments add up to almost $600,000. The remaining interest payments, and essentially, the Bank of America thing was only. The penalty was 150 or something like that, right? And and the interest that was included in that analysis was only $31,000, right?
Yeah, because basically they took the penalty as the prepayment fees, which is the tax adjusted, time value of money, and
Right.
the interest is the accumulated interest through the date that I asked
Right,
for it.
right,
Yeah.
right.
And what'll happen when I get this redone is that accumulated interest will go up a little bit, and the payment fees will go down a little bit because they'll have less earnings time.
Got it.
But I don't have any reason to believe, nothing dramatic has changed that will change that bank payoff amount, move the needle to a place where we don't have savings, both present value and cash savings.
Okay, any more discussion?
Yeah, I was a little confused in looking at the number on your attachment C as the debt service principal and interest of $3,356,000. What's in that number?
That was actually, I'm trying to think how I put it. I think that was paying it, that was maybe my original calculation of what it would take to do it with only the savings of, what was the amount? 80,000, something in that nature. In other words, I didn't originally think, I knew it wouldn't be the whole 3,381,039, but I didn't think we would save as much as we're saving.
So that number probably was an earlier number and probably matched better. Okay.
Anything else?
No.
It also, I believe, if I'm not mistaken, took into account making the October 1st payment as is before we got the prepayment payoff amount, because I knew we wouldn't get the FP&L proceeds before October 1st, and we went ahead and made our normal first principal and interest payment, which is the $287,826. So I knew you wouldn't have any savings on that portion of it.
Okay. So I assume it makes sense to vote on these two individually, right?
That would be good, yes, so that council can see them in
Do I
full.
hear a motion?
I move that we approve of the proposed payoff of the marine.
Do we have a second?
I second it.
All in favor?
Aye.
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 Okay, motion carries.
Excellent, thank you. So moving on to the next one, which is very similar but a different topic, and that is the payoff of the Series 2007 B2 Dodgertown loan. Again, this was part of the recommendations that you endorsed for use of the residual proceeds from the sale. We do have the funds now. This loan, which was let at the same time as the 2007A, contains an identical prepayment clause, so all the things I said about that are true here as well. And you can see, again, what we adopted, what the actual payoff will be, what the remaining principal and interest payments are, and the cash and present value savings over the life of the loan. A couple of things about this. There were actually two loans for Dodgertown. One of them was principal and interest for a period of time. This one was set up as interest only until the other one went away, and then the interest payments on this one kicked in. So that's the reason you see a $5 million principal amount, as opposed to everyone talking about we paid 10 for Dodgertown. There were two separate loans that were taken out, and the other one has been paid off, and the interest has now kicked in on this one last year. So that's one thing to keep in mind. This loan, like other loans, the property itself is not the security for the loan. The pledged revenue is any non-ad valorem revenue sources of the city, which in our case is 1 cent sales tax that we've pledged to pay off this loan. And so, as we talked about this during budget season, to me, the advantage of paying this one off is a couple of things. First of all, we're paying this loan with our 1 cent sales tax, and that money is the money that we also use to pave streets, to do stormwater, to repair aging recreation facilities, and by paying this loan off, we would free up about $660,000 a year worth of 1 cent sales tax for the next 8 years. And as a matter of fact, our adopted budget, which included the payoff of this loan, contains $660,000 worth of projects in 18-19 that cannot proceed unless we do this, and a similar amount in the next 4 years. The second thing is that, again, because the property itself is not the security for this loan, the payoff of this loan, in my mind anyway, is a separate conversation from what we intend to do with the property, keep it, sell it, whatever we do. at the current sales prices that we've received, that money doesn't come close to paying off the loan. And so I'm suggesting to you that we separate those conversations, pay this loan off, be free of it, free up our 1 cent sales tax money, and then whatever we decide to do with Dodgertown, if for some reason we sell it, great, now we have another 2.4 or 2.5 or whatever it goes for to throw into the mix of capital projects or anything else that council wants to do with the money. And so, again, if you watched the meeting yesterday, the county did make a proposal to buy the property for $2.4 million. At this time, council has decided to decline that and to explore some other options for parking in Major League Baseball and the different things that go with it. But, I think the conversation about what will we do with Dodgertown and should we sell it will continue. I don't know if the city manager probably agrees with me there. I don't think that was a final decision. I think that was just, let's look at this some more to figure out what's best for everyone. And so taking the loan off the table and out of the conversation, I think is a good thing to do, in addition to the $660,000 worth of infrastructure. The interesting thing about this is, if you free up that infrastructure money, that 1 cent sales tax money is required by law to be expended on capital projects. So you've created a stream of revenue for the next 8 years that cannot be spent on anything else. Whereas if you take this money and say, well, I'll just put it in the bank and pay the Dodgertown loan with it every year, it may or may not go towards capital projects. It may or may not go towards that. And so that's why we're saying, let's just do that with it now.
And we have a huge backlog of critical projects.
Even with, if you look at the 5-year capital plan, even with this money included for the next 5 years, $660,000 a year extra, we still have $5 million worth of unfunded projects against that same time frame. So we're not going to run out of stormwater, beach boardwalks, streets that need to be paved, and recreation facilities, police facilities, cars, that kind of thing. So with that, I'm again happy to answer any questions, and staff's recommendation is that we put this separately in front of council and ask them to proceed as they budgeted to pay off this loan at the earliest possible date.
Questions?
Was this payoff, the remaining cash, free cash, was what, 24 million from the sale?
With these two payoffs plus all the other suggested uses, there were still over $20 million of a balance
In free
remaining
cash.
as of this estimate. I will tell you, I'm reworking my available cash balance after the utility is sold based on what really transpired and is transpiring even as we speak. And that number, this starting number, may actually be better than the 58. It won't be worse, but it may be better than the 58. So there's at least 20 left over.
Now, how much, when a few years back, we talked about how much cash reserve we needed to maintain. Did that include this amount that you have in there for the utility? No. It did not include that. That was separate.
That is separate because
So this money will not be necessarily used for that cash reserve. Okay.
Because that was the general fund.
Okay,
So,
that's
and this
right.
is electric utility cash.
Yeah.
So the general fund has, in accordance with the policy
So
we
if the
adopted.
utility is not there, then that money is not
That
needed for
general
that.
fund money, we've stayed within the confines of our policy. We've had the adopted, we've set aside the storm reserves,
Okay.
all that. Yeah,
Thank you.
we got that over here. So that's truly residual cash that after we do all these other good things with it, council has, more wherewithal for whatever they think is the most important.
Okay.
Catherine?
No comment.
Okay, and I think it's a directly parallel thing to the marina deal, right?
Same prepayment penalty clause.
The return on this project essentially is in excess of what you can reasonably get, and it would be earmarked for a very appropriate purpose.
Right. And alternatively, if this isn't done, the things that we did budget to do this year, 600,000+ of those projects can't proceed unless we take some other cash and throw it at them. We're kind of waiting to see how this goes down.
And granted, these don't come close to the $2.5 million that we have to make up over the next few years, due to the electric sale. It helps.
Well, again, these don't help that because that's in the general fund, and this one's in the marina, and this one's in the infrastructure fund. But one of the uses of the residual proceeds before we get to the 20 million is the whole idea that we're going to we already did this fiscal year, fill the $2.5 million gap.
Phase in.
And then 500 less and 500 less. Now, when we get to this budget season, that will be, where we'll have to tackle that one and see if that's still what council wants to do. But there are a couple of other recommendations. Well, I'll let you go ahead and finish.
No, that's fine.
Yeah, let you go ahead and finish with this one if you want, and we can talk about what's coming next.
I'm sorry?
I was going to let you go ahead and finish off with this one, and then we can talk about what's coming next if you want.
Okay. So if there are no more discussion,
I do have a question on the electric fund attachment A. The beginning balance at 10-1, the 28,000, that is money that we were allowed to keep.
No, that is money we already have in our electric utility.
Right.
Remember,
and
we
were allowed
keep a
to keep our
90-day.
cash. That was not part of the sale, so that was the cash we had.
Yeah, they didn't get any of it. That was the
Okay.
cash we already had on hand because we maintain a 90 to 100-day operating reserves in the electric utility for bond ratings, et cetera. So yeah, that's the money we brought forward into this fiscal year.
And now, our cash at the end of the period is 42,000?
42 million.
42 million, I'm sorry. So the difference would be what we really netted, right? The 28 to the 42, the difference is kind of what is free and clear?
Yes, and though keeping in mind that 42 isn't the same as this 58 because this 42 is after some of these things got done.
Because we have, from the beginning to the end, we have a difference of about 14 million.
And that's because some of these things that were up, this 58 and this 42, the difference between them is some of the things that were here that are actually incorporated into the budget. And then the other thing is, that makes it even more confusing, is this shows us making the debt service payment, which we had to do on December the 1st, and the proceeds being 30, and it turns out that the way the deal was structured, whatever net amount had to go into the bond defeasance, because we made a payment, would actually come back to us instead of just we were out because we made the debt service payment. So that's where this may improve. But again, this was done before the FY 18-19 budget, and then we did the FY 18-19 budget, and some of these things are already in here. Not all of them, but some of them.
got it.
And that's why I'm redoing this, Okay, this is what I thought was going to happen, and I'll probably end up breaking this out into this is what we really had when the dust settled, this is what we already spent in the 18-19 budget, and this is what we have for 19-20 and forward.
Excellent. Okay. Any further discussion on the Dodgertown loan payoff motion?
I move we approve the recommendations for the Dodgertown payoff of the Dodgertown loan.
I'll second it, if I'm allowed to. I guess I am. All in favor?
Aye.
Aye.
Aye. It passes unanimous.
Great. Thank you very much. So among these recommendations, we had these two loan pay. Does anyone have a copy of this? I have extras down
I
here.
have a copy.
Let me give you, it'll be easier to talk about what's coming next if you have a copy of this in front of you.
Thank you.
I thought I had a copy.
I just didn't know what it was, so thank you.
So basically, we have the Series 2007B2 and 2008 Dodgertown
sorry.
loans. They're toward the bottom.
I'm sorry, Cindy. Do you have one more copy?
Sure.
I thought I had it.
So if we're using this as a checklist, if you go down to the last two items there, those are the two that you just approved. And so those are essentially taken care of. The lump sum contribution to the pension fund was part of the sale, and that was the 6.6 million, and we're going to add 3 to it, again, per the adopted budget, to basically take care of the electric utilities portion of the pension fund. So that's taken care of in the 18-19 budget. And so we have two things left. The declining annual cash contribution to mitigate the gap that we just talked about, and that's just a function of what we do each year in the budget. We've made the recommendation. We've done the 18-19 part. It only came out to $1.7 million because it was only for 3/4 of the year. But when we get to next year, and when we get to the preparation of the 19-20 budget, that's when council is going to have to decide if they would like for us to lower that, that gap to $2 million, or fund $2 million and find a way to close the other $500,000, and that will just be a function of what happens this summer. So the last thing that we have to do out of this list is setting aside the funds to make the annual payments on the unfunded pension liability for the general fund. We have done the first year of it as part of this budget. $1.8 million is being transferred from the electric utility into the general fund to make this year's general fund pension payments FY 18-19. What the Finance Commission talked about when they endorsed these recommendations, and what the council also endorsed when we talked about it during budget season, was to adopt a resolution before the end of this year to formally set aside that remainder as a committed fund balance to be drawn down only to make those pension payments. And so either your next meeting, probably your next meeting, so that we can get it in there before budget season, I'll be bringing you that resolution to review and to, revise if you see fit, and to make that recommendation.
You'll
to
be
council.
bringing it to the Finance Commission, okay?
I'll bring it to the Finance Commission.
When do you think that would be?
Whatever your next quarterly meeting is.
That 18 is an estimate, depending on.
That 18 is an
Because that will
estimate.
vary year to year, depending on interest rates or earnings rates.
It is. And actually, the way that we talked about doing it, that I'll probably do, is I'll make it the 18, and then the resolution will be constructed so that once the pension plan reaches full funding, any residual amounts of the 18 would be freed up for whatever.
Okay.
So we'll go ahead and roll with that number, because we have to peg it to something right now.
We're not talking about full funding by selling this to somebody or paying somebody to take it. We're going to maintain the pensions.
We're going to maintain the pensions.
So full funding will change from year to year.
Right. Right now, with the pension frozen that we did in 2015, we set it up to be fully funded over an amortization period of 12 years. We're a couple of years into that, 3 now.
Okay.
And everything's on track with our actuarial assumptions, and we're up over, I don't have this year's valuation yet, but we were up to about 73% funded at the end of last fiscal year.
Sure.
And
with
so if this remains on track.
Earnings rates very low now, it's not apt to go up, it's more apt to go down. Right.
And so what we're proposing to do is, instead of making the general fund pension payments with general fund money, make the annual general fund pension payments with residual electric utility cash till we reach full funding.
Right.
So it's a combination thing. We're going to take the electric utilities part of the current liability and just fund it and do away with it. And then we're going to annually continue on our track for getting to full funding across a decade. And then if we get there sooner, we'll release these reserved funds.
Right.
And then from that point forward, our quote-unquote normal cost should only be just,
But my point is, the risk of that changing is less that it'll go up than it will go down. With interest rates as low as they are now, they can't get much lower.
True, and again, keeping in mind, though, that now when you have a pension trust or an OPEB trust, you're not restricted to the kinds of investments that you're restricted to by Florida statutes for idle cash. So our investment mix in the pension funds is very much a 30-year pension fund mix that includes equities and, all
Right.
kinds of other things.
Right.
And so, in addition to that, when we froze the pension plan, we were required by the state to lower the investment return assumption dramatically. And that had the effect of increasing our liability dramatically, but, we lowered it to 6.5%. So the combination of those two things and our recent earnings, our actual pension fund contributions actuarially every year when we true them up have been lower than we've budgeted for the last couple of years. And if we stay on that track, we'll get to full funding before we use up the whole 18 million, and we'll just set the resolution up so it can be, freed up when we get there.
Okay. Thank you.
So anyway, you'll see that coming to you, and then that will get us, then we're done. We're done with these recommendations. And we'll just have the annual budget process to get through.
So those two, the 18 and the 3, those are benefits to the general fund.
The 3 is a benefit to the electric utility. The electric utility liability that was funded directly by the FP&L sale proceeds, in other words, it was called out as a line item, of 6.6, was only for those employees that FP&L was taking on. Remember, the full electric fund liability includes employees of the electric utility from the past who have already retired.
Okay.
So the 3 is the extra that you have to throw in to do away with the entire liability associated with the electric utility, both the current employees and the past employees.
Okay.
And yet, it's still a benefit to the general fund, because if you don't have an electric utility...
Then you have to fund it.
But you have electric utility pension costs, they have to go somewhere.
That was my point. Yeah. Excellent. Okay.
It's not so much a benefit as it prevents a detriment, and I think would be the way I put it. The general fund won't have to absorb electric utility-related costs that it wasn't prepared for. Yeah.
Okay.
Good point.
Any more discussion on this schedule from the council members?
I'm all set. Other than that,
Do you?
I'm
go ahead.
I'm
Nope,
not
take your time.
quite- I
Take
think
your
I'm
time.
clear on this, that what this shows me is that the general fund will have about $1 million less because we've taken the bonds out.
$1.8 million.
Well, annual, about 950,000, 998,000.
No, annually, the general fund pays about $1.8 million towards the pension liability.
No, I'm not talking about pension. I'm talking
I'm
about
sorry.
the money freed up from the sale, from the payment of the bonds. It's about $1 million a year.
I'm sorry, I'm not following which number we're coming to.
Items 3 and 4 in this sheet, 4 and 5, sorry.
Not the general fund. The first item we're freeing up is the capital
Oh, those are in the
project
marina fund and the utilities
They're separate
fund.
funds, yeah. So the marina one frees up money in an
Okay,
enterprise
so
fund.
that is not going back into the
No,
general fund.
not going
All
back
right,
into the general
okay.
fund. The general government capital and construction fund is a completely separate fund from the general fund. It's funded just with 1 cent
That
sales
answers
tax
my
rate.
confusion, so
Yeah.
it's not comparable, and it's not part of the first item at all.
Yeah, not
Okay.
at all.
Now, downstream, once the marina is healthy, it may generate more than the $100,000
Absolutely, that is...
it currently gives to the general fund.
Right,
so.
which is calculated at 6% of revenue, kind of in the nature of a franchise fee. Again, that's a council policy decision. They could certainly take more than that out of the
sure.
marina if they
Yeah.
would like. I mean, it's not a franchise fee, so certainly if the marina were to become extremely healthy and throw off more revenue, council's certainly welcome to take more than 6% and
Yeah.
contribute it to the general fund to offset other kinds of
And
costs.
I'm
Absolutely,
sure the council took that into account in the decision to keep the marina.
yeah, possibly.
So Cindy, just for my benefit as a newcomer to municipal government, the notion of a franchise fee, I notice it's in essentially all of the enterprise, funds do that. Just a little, the concept of it, what is it intended?
I think probably the best example is that now that the electric utility is sold, we couldn't charge ourselves a franchise fee because we weren't franchising ourselves, but there is a franchise fee on electric utility bills now because the city has granted a license to operate, if you will, to another entity within its boundaries for
And
them
it's
to make
perfectly
money.
right to get some return on it.
Exactly, and those are classic. I mean, franchise fees are kind of a classic. Even when the city had its electric utility, there was a franchise fee imposed by the county outside the city limits because essentially the county had given us a franchise to operate our electric utility within their boundaries, their county boundaries. So a lot of governments will use that 6% franchise fee. Again, if you had a solid waste provider that wasn't you would collect from them a 6% franchise fee to operate within your territory. So a lot of governments, and ours in particular, just kind of use that 6% as a proxy for if you're running your own water and sewer fund or your own solid waste fund, just as return to the general fund. But I've certainly worked in places where it wasn't tied to that number and it was whatever the market would bear in terms of, like if you had a marina, you wanted enough money for capital improvements, you wanted it to cover its own operating costs, and whatever was left over would come back to the general fund because you're not operating that marina just to make money, you're operating that marina to cover its own costs and to be a potential revenue source to the general fund, and that is absolutely a policy decision. I think when we first came on board, the amount that was transferred from the various enterprise funds sort of went up and down according to the needs over time, and we settled in way back in 2012 to the idea that 6% was appropriate for everyone, and then there was a predictable amount that
So
everyone...
all the funds are at 6%?
All the funds are at 6% of customer revenue.
All of the enterprise funds, right?
All the enterprise
Of revenue.
of customer revenues, yeah.
Okay. Anything else, Cindy, in terms of finance director matters?
Nothing that I can think of, unless anybody has any questions.
I want to just throw out just a very general question, and Cindy and I had the same discussion with city manager. How to come up with the areas that the Finance Commission might address. And I did send out a memo, didn't get much of a response back, particularly from council. It clearly seems appropriate that commissions be directed by council. In the charter, there are some specific kind of green eye shade type things that...
Like this, like the loans.
That were, pick an account, the recommendations on selection of accounting firms, things like that. But there is kind of verbiage in there that suggests that the Finance Commission could be self-directed to focus on some issues. And I just would like to open the discussion to how do we, I think we're making a commitment of time, as part of our agreement to serve on the commission. How do we decide what the most constructive things to focus on would be? And clearly, you've been helpful to me in preparation for this meeting. But just any thoughts that you would have, Cindy?
I have a few thoughts. Selfishly, for me, I bring to the Finance Commission things that that council's interested in, but not necessarily prepared to spend the amount of time it takes to really work them through. And two examples that spring to mind that the Finance Commission's gone through in the last couple of years were the creation of an OPEB trust, which was a very deep dive over multiple meetings until the recommendation was made and the trust was created. And at a fairly complicated topic, we actually had my actuary, who's kind of the expert in the field, come in and speak to the Finance Commission about the pros and cons. The establishment of a general fund balance policy, which took us multiple meetings, because council may say, hey, we'd like to have a general fund balance policy, but working through the details and the possible consequences of that are not something that fits within the confines of a council agenda. And so whenever I have something like that council has said, hey, let's do this thing, and I want essentially to bounce it off someone who has the time to spend and the expertise to talk about it, I'll bring those things. Clearly things like loans, selection of accounting firms, the CAFR, which we talked about at length each year when it gets produced, because again, that's a long conversation that, people on the Finance Commission are sometimes interested in having, and again, we don't even make a CAFR presentation to council. It gives us the opportunity to talk about it. So for me, it's things that sort of arise out of the course of doing business for me, or things that council says, hey, let's look into creating an OPEB trust, let's look at our pension fund, let's look at this. So if you look at the Finance Commission agendas for past years, things like freezing the pension plan were in there. Insurance issues have been in there. Investments have been in there. So those things just sort of arise naturally. And then, again, it depends on the things that council's working on. I mean, councils have specifically said, let's kick that back to the Finance Commission and have them talk about it for things, a lot of things related to the electric utility sale. You guys were specifically asked by council to get involved in. So I'll always have a number of things that will come just up in the natural course of doing finance business over the years under finance directors matters. And then I think council, almost always has some special project on their plate that they may or may not say, hey, how about take that to the Finance Commission and bring it back? I know the other members that have been here for a while might want to speak to that too.
Well, even though you find that the language leaves it open for self-direction, I'm really not in favor of self-direction. Right. I see us as an advisory board to be helpful where we're wanted, not to be auditors, or, I don't want to make the issues, I just want to be advisors on an issue when we're called upon, either by council or Cindy to offer input. It's just my personal opinion.
It is a difficult question because we can help with the financial issues, but in terms of city policy, if we don't rely on council direction, I think we're just wasting our time in most cases. In other words, just for example, if we were to take on what to do with the power plant land, we'd be wasting our time. That's a council policy decision. If they want to look at the financial aspects of different alternatives, we could help there. But I don't think we should initiate something like that. That's out of our league.
And you'd also be taking on the Parks and Rec Commission, because the other thing to keep in mind that we've talked about before
And if
is
they want to
when we
look at-
talk, we've had extensive conversations over the years about the appropriate funding of parks during budget seasons, but there's a complete Parks and Recreation Commission dedicated to that. Same with the marina. The council actually said last night they want the Marina Commission to get involved in this moving forward of the marina.
Right.
So there are lots of other commissions, utility, all of them that also have a piece of that puzzle. That
And
make a good
as a member, I just did that with the proposals for the leasing of the marina, which we were asked to review the proposals, which is, I think, appropriate. Turns out the council decided not to lease, but that's their decision. That was not ours.
Exactly, right.
And you make another great point, sorry I forgot that, where appropriate, we've had members of the Finance Commission as members of city selection committees. I believe Glenn Brevant sat on our selection of a 401 provider, maybe. So there's been times where we've had RFPs out for finance-related things where we've asked for a volunteer, and you did that for us with the marina,
Right.
and we appreciate that, because that's a little bit extra work having to go through those proposals. We really appreciate you
It was
guys doing
interesting work, but
And I could imagine, were we to do the engineering study that was discussed for the marina, there'll clearly be a financial aspect to that, and that might be an area that we would be asked to. But the way to do it is to wait until either you or the council decides that this is an appropriate thing for us to focus on.
And/or, that OPEB discussion actually evolved from conversations the Finance Commission had during reviews of CAFRs that then turned into, let's make a recommendation about a trust, that then turned into, let's really look at what it takes to fund a trust. And it took a couple, 3 years, because the dollars were big for council to actually budget that despite Finance Commission recommendations. And so sometimes the review of the annual financial statements or the quarterly, budget versus actuals, or even the budget adoption leads the Finance Commission to something that they're interested in and want to talk about more.
I would prefer to leave the wording in our charge as it is and say that it's not our job to go out and look for things. If we know of something that might be appropriate to bring forward, what some other city is doing, or something that we wanted to bring forward to talk about, I think is appropriate. But we're not to go out, I don't think, and search for things that
And because as in your experience on the commission for years, you don't have to search for things, they will find you.
They'll come up.
There just will always be something that arises out of the natural course of business here that will end up back with the Finance Commission, either through me, the council, or the city manager, or for your own interest in something that you're like, hey, tell us more about this. So I think that interesting things have been finding you over the years.
Well, that's helpful to me. Looking at the kind of very specific things that the city's, the Finance Commission is supposed to look at, how would you, when would be the appropriate time for us to review monthly financial statements next?
We don't do monthlies anymore, we do quarterly. And that was a decision of the Finance Commission a few years back after we were doing monthlies and realized that we had our budget to actual controls back on track. And so we've been doing quarterlies. We typically have the quarterly, we have the general ledger closed and all the reconciliations done by the 20th of the month following the end of the month. So we're done with December by January the 20th. And in terms of producing reports based on that, it takes another week or so to do those consolidated, we don't just hand you the general ledger, which is about that thick. We consolidate it into report, and we do a variance analysis. So what we've been typically doing is the first week or the second week of the month following, in other words, December in the first part of February, March in the first part of May, And then the final one for the year, you just wait for the CAFR, because anything else preliminary is sort of irrelevant.
When are the audit, the final,
The CAFR?
last year's equivalent?
The CAFR is, the deadline is typically the end of March for submittal to GFOA, and I'm really hoping, despite losing pretty much a month to the electric sale, that we're going to stay on track. I actually was on the phone with my auditors yesterday, and we think we'll still be able to make the end of March deadline on that, so that's what we're working towards right now.
Okay.
You know, but if you wanted to see a first quarter 17, 18, 19, that would be first or second week of February. I would beg for the second week of February only because we're still trying to recover from December.
I'm sorry, that would be when
Second week of February?
that you would want us,
If you want to see if you want to have a meeting about the first quarter FY 18-19 report and variance analysis, that would be appropriate in the first part of February.
okay.
I will
guess
tell you
would
typically the
recommend that we
first
do
quarter.
one and see what the feeling is after going through one of them.
Yeah, because I will tell you, typically the first quarter is pretty unexciting. You know, if we're going to have big budget variances, they're not going to kick in the first 3 months.
Yeah, it was a little bit of a trick question because I was trying to figure out when we should meet next. And
I would say if you want, because it would be February, May, I would say the resolution that we're talking about for the thing would be more appropriate for May than first part of February, just because I'm just going in my mind through everything else that's going on, and it would still be in place before next fiscal year kicked in, because we don't have budget workshops till July. So if you want to look at first quarter financial reports in the middle of February, we could certainly do that.
It's what happened with the first quarter often where there were front-loaded expenses. So the variance analysis would go into all of these numbers because all the insurance had been paid,
Yeah.
in the first quarter. So some of that was not, that useful. Other expenses were just was too soon to be going over. So, I would agree that the first quarter is a little not giving us too much information that's usable.
I mean, we'll still produce the report and do the variance analysis, but you're absolutely right. 90% of the variance analysis is going to be, this variance is within expected parameters. For instance, we get the bulk of our ad valorem tax revenues in November and December, and you're going to see a huge variance. So it's so little of what we get and do is pro rata. I mean, so little of the significant expenses that we have lay themselves out neatly over a monthly basis. So, but we'll do the reports anyway, and we'll do the variance analysis anyway. So if you want to meet and talk about that and see what else has come up, we can certainly do that. I'm totally up to you. I'm here all day.
Were you suggesting that it might not be a particularly useful exercise?
Not after one quarter, as Cindy said.
Well, why don't we wait until quarter?
Mid-year is better in case there is really a trend.
One comment is, when I first came on the Finance Commission, it was useful because it taught me a lot about the financial statements and the budget and the timing and what's happening in the city. In that sense, it was useful. And I think it probably still is to reminder, but you're right in terms of, do we see something that has to be changed? No. We're saying, why did this happen? And you can explain it to us so we understand better what's happening. That was the benefit to me. I don't know whether it benefited you or not, but probably not.
I think it was a benefit for you guys. But no, it does benefit me when you understand it better, because then that gives everyone a feeling of comfort that the city, as when I first came on board, and Jim will attest to this because he and I first came on board at the same time, they were headed for about $800,000 over budget variance at fiscal year end, and I came here in July. It's a little too late to do something about that.
Right.
What we did over the years was we kind of put some budgetary controls back in place when department heads, are expected, they're treated like cost center managers, and they're expected to live within their bottom line. And if they have something happens that they didn't expect, then they have to figure out how to live without something else to the best of their ability to stay within their bottom line. And I think if you look at our budget, original budget versus actual budget versus revised budget versus actuals for the last 4 or 5 CAFRs, we're coming in at or under our original budget, and with increases to things. So that took some time.
Sure. Let me propose a compromise. Why don't we do one review at mid-year and decide from that whether we want to do more? Instead of trying to,
Mid-fiscal.
after the second quarter.
After
Look at the
fiscal
comparisons after the second quarter, and that should be sufficient, unless
and we will
something major changes.
Yeah, I
And
think
we'll
that's
still
perfect.
produce and send the first quarter report, because we
To
post
us.
them on the website, to you, we post them on the website, everybody likes to see them, we'll still do it. If when you get that, and you see something that you really want to meet and talk about,
can
you're
call.
going to get it anyway, absolutely set up a meeting. What I would suggest is maybe let's go ahead and set our next fixed meeting for sometime like mid-April, and then we can go over the CAFR and also any financial statements up to that point in time. But we can go over the year-end results from last year, and by then I could get you the resolution for setting aside the pension funds as well.
I think
So
that's
if you want to fix a meeting for April and then just play it by ear in case you want one between now and then, that might be the best approach.
That sound good? Okay, April, you'll figure out the date?
Right, because I'll need to get with the
Yeah,
other members
after
as
the
well.
tax deadline, because you have Mr. Nettle and myself.
You tend to be
right.
busy that time of year.
Yeah.
That works for me, because that'll give me extra time in case I don't, like I'm squeezing right into the deadline for the CAFR because of everything that's going on. And that'll give us good 2 or 3 agenda items, so.
Okay. I lost my agenda. Okay, any issues the members would like to bring up?
No?
Clerk, I believe you have one agenda item.
Right, what I have before you is the annual report that'll be submitted to the city council along with the other boards and commission reports. And I just need to have approval from you or suggestions if you have any changes but it'll supposedly be going on in February.
I read through it and I had no issue with it.
No?
Good.
Okay.
Thank you.
Okay, we have one more topic. Someone want to make a motion to adjourn?
I move we adjourn.
Second.
Anyone dissent?
Discussion.
Thanks, guys.